Welcome, everyone. Today, we will explore the dot-com bubble burst of 2000 to 2001. This event reshaped the technology sector and financial markets worldwide. Over the next few minutes, we will review the timeline, the parties involved, what happened, why it happened, how it unfolded, how it ended, and which countries were affected. In the mid-1990s, the Internet revolution began. Venture capital poured into technology startups. Between 1995 and 1999, the NASDAQ surged by more than 400%. Dozens of internet firms went public, many without profits, riding the wave of investor enthusiasm. By March 2000, the NASDAQ reached its all-time peak of over 5,000 points. This marked the height of the bubble. But investor sentiment soon shifted, and the market began to unravel. In April 2000, the sell-off accelerated. Over the next 2 years, dozens of dot-com companies went bankrupt. By 2001, the September 11th attacks further shook confidence, worsening the recession. By late 2002, the NASDAQ had lost nearly 80% of its peak value. The crash destroyed trillions of dollars in market value and reshaped the investment landscape. The key players included technology companies such as Amazon, Yahoo, eBay, Pets.com, and Webvan. Retail investors, venture capitalists, and institutional investors fueled the bubble. Investment banks underwrote IPOs, and regulators such as the SEC and Federal Reserve played oversight roles. Media outlets like CNBC and the Wall Street Journal amplified excitement around tech stocks. Employees and consumers were also drawn into the hype. The late 1990s saw a mania in technology company valuations. Many firms had weak or non-existent business models, but attracted massive investment. When profitability failed to appear, stock prices collapsed, companies folded, and trillions in wealth evaporated. Several forces were at play. Speculative mania drove investors to chase internet stocks without regard for fundamentals. Easy capital, oversubscribed IPOs, and abundant venture funding fueled the frenzy. Media hype reinforced optimism. Many firms had no viable business models. Finally, the Federal Reserve raised interest rates in 1999 and 2000, tightening liquidity and cooling speculation. Investors poured money into IPOs of internet companies, driving valuations to unsustainable levels. When profitability never materialized, confidence collapsed. Stock prices plummeted, venture capital dried up, and companies quickly burned through cash. High-profile failures, such as Pets.com, became symbols of the collapse. By 2002, the NASDAQ had bottomed out. Thousands of companies had failed, but survivors like Amazon, eBay, and Google eventually emerged stronger. The crisis prompted reforms in corporate governance, including the Sarbanes-Oxley Act, to restore investor trust. The United States was at the center of the bubble and bore the greatest impact, with massive losses and a recession. However, the effects spread globally. Europe and Asia saw sharp declines in tech stocks and venture funding. Emerging markets tied to U.S. capital inflows also experienced volatility. The dot-com bubble burst of 2000 to 2001 illustrated the risks of speculative excess, weak business models, and easy money. While destructive in the short term, it cleared the way for stronger companies and more sustainable growth. For finance professionals, it remains a powerful lesson in valuation, investor psychology, and market discipline. This concludes our discussion about the dot-com bubble burst of 2000 and 2001. See you at the next lecture.